Hey, it's David from Advantage Accounting Group. As we head into the final stretch of the year, most business owners are focused on getting everything wrapped up, like closing the books, sending invoices, finishing projects. But this is also one of the best times to grab a few easy tax deductions that can make a real difference when April rolls around. Today, I'm going to walk you through a few simple, legal, and often overlooked deductions you can still take before December 31st. And if you like straightforward, plain English tax tips like this, make sure to like, subscribe, and share this video. It helps more business owners and it also helps the channel. So let's start with a classic. It's called the Augusta Rule. This rule lets you rent your home to your business for up to 14 days each year, and that income is completely tax-free. That means your business gets a deduction, but you don't have to report the rental income on your personal tax return. You can use it for legitimate purposes like team or board meetings, strategic planning sessions, or even an appreciation dinner. The key is to document this. You'll want to note the business purpose of the rental, keep a record of the dates used, and document a reasonable rental rate. I've done a blog on this strategy that you can use. I will put a link down below to that blog. Next up, paying your kids. If your children help with real work in your business, things like filing, packaging, helping with admin tasks, or even social media, you can pay them a reasonable wage for that work. The business gets a deduction, and because your kids are likely in a very low tax bracket, they'll pay little or no tax on that income. And here's the long-term win. They can use some of that earned money to contribute to a Roth IRA. That means you're not just saving taxes this year, but you're teaching them how to save money for the future. Just make sure it's actual work, age appropriate, and that you keep time records and proof of the payment. It's one of my favorite tax strategies, and actually there are multiple ways to do this so that you could even avoid payroll taxes as well. If your business uses the cash method of accounting, you can prepay certain expenses now and take that deduction this year, even if they occur part of next year. Things like rent, insurance, subscriptions all qualify as long as they're for 12 months or less and are ordinary business expenses for your business. It's an easy way to smooth out cash and reduce this year's taxable income. If you had a higher income this year, this is a great tool to bring that down. Next is tax loss harvesting. Let's switch gears to your investments. This one is called the tax loss harvesting. If you've got investments in a regular brokerage account, not inside a retirement account, you can sell losing investments to offset any capital gains that you may have or want to take. If your losses are more than your gains, you can even deduct up to $3,000 of the leftover losses against regular income, and then any amount in addition to the $3,000 would then carry forward to future years. But the goal is to be able to use that loss against any potential gains that you may have so that it nets to zero. Just watch out for what's called the wash sales rules. You can't buy the same stock or fund back within 30 days or the IRS will disallow the loss. This can be a simple year-end move that saves you money without changing your long-term investment strategy. Now let's talk about something that's easy to forget, mileage. If you use your personal vehicle for business, the 2025 rate is 70 cents per mile. That can add up quickly. Even short drives to meet clients or pick up supplies count. Here's what the IRS expects you to track: the date of each trip, where you went, purpose, and the starting and ending mileage. The easiest way to do this, use a mileage tracking app or keep a quick note on your phone. And before midnight on December 31st, take a photo of your car odometer. That's your official year-end mileage and actually the beginning mileage for the next year. Next up, charitable giving. If you plan to give early next year, consider doing it now because starting in 2026, a new floor or threshold will apply before charitable deductions start to count. That means you may not get as much of a deduction in the future for the same donation. This floor is set to be be 0.5% of your income. So that means anything that is below this 5% would not be deductible. Everything above would be, as long as it's within certain limits. You can also get a little creative here. You could donate appreciated stock instead of cash to avoid capital gains, or use a donor advised fund to bunch several years of donations into one. And then you can decide later where you want to apply those donations. If you're already planning to give, this one is the one that you want to do before the end of the year. So to recap, before December 31st, you can rent your home to your business under the Augusta Rule, pay your kids for real work, and help them start saving for retirement, prepay next year's expenses if you're on the cash basis of tax reporting, review your investments for tax loss harvesting opportunities, track your mileage carefully, and take that picture of your odometer. And don't forget to make those charitable gifts while donations still work in your favor. A few of these small steps can easily add up to thousands of dollars in tax savings, and most people actually miss them. If you'd like help reviewing your situation, grab my 5-step year-round tax saving checklist. The link will be below. Or you can schedule a 15-minute year-end tax checkup with me. I'll help you find a few easy wins before the clock runs out at the end of the year. And if this kind of plain English tax advice helps you out, please like, subscribe, and share this video with another business owner who hates overpaying taxes as well. Thanks for watching, and I'll catch you on the next one.